Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Saturday, February 24th, 2024. This week, the stock market continued the strong rally that commenced 3 months ago. Yesterday, the S&P 500 index hit a new all-time high, while the NASDAQ Composite Index and Dow Jones Industrial Average did the same. Based on that statement, you might think all sectors of the stock market are doing well. That is not the case. First, I'm going to show you a chart of the S&P 500 right here over the past 6 months. And you can see, again, I've talked about this before, bottomed out basically at the end of October, and since then a steady rise. In this case, it's gone basically from almost 4,000 to 5,000. So, that's a 25% gain in less than 4 months. Meanwhile, the NASDAQ, again, past 6 months, also bottomed out at the end of October. It's also up by a similar amount. And here's the Dow Jones Industrial Average. Again, all three charts look very similar, partly because there is overlap between them, also partly because they all essentially track large cap and mega cap stocks. But if I've noted previously, small cap stocks, as measured by the Russell 2000 Index, have gained no new ground this year and are well below their peak 3 years ago. So here's the Russell 2000 over the past 6 months. You can see it also bottoms out at the end of October, peaks here in late December, but since then, no new ground. And if we go back 5 years, you can see over here, and this is peaking around October, the fall of 2021, October, November, it's still about 10% below that level. So there are a lot of mid-cap and large-cap stocks that have failed to participate in the rally in addition to small-cap stocks. I believe that discrepancy creates a long-term investment opportunity. At some point, Wall Street will realize the companies leading the stock market's charge are fully valued. For example, this week, NVIDIA traded above $800 for the first time ever and is up nearly 600% since we recommended it 16 months ago. Don't get me wrong, I'm proud of that huge gain that we've racked up in NVIDIA, but I doubt it can continue rising at its recent pace. Nevertheless, NVIDIA and the 6 other companies that comprise the so-called Magnificent Seven continue to appreciate at an accelerating rate. In addition to NVIDIA, the Magnificent Seven includes Meta Platforms, formerly Facebook, Amazon, Apple, Alphabet, formerly Google, Microsoft, and Tesla. Those are all very successful businesses that deserve high valuations. You won't get an argument from me about that. But what I do question is, how high of a valuation is too high? If they were rising 2 months ago on the expectation of Fed rate cuts commencing soon, then why are they still rising now that such a scenario appears unlikely based on recent economic events? Meanwhile, there are hundreds of companies generating solid operating results that are currently being neglected. They are profitable and growing, but not to the same extent as the Magnificent Seven. For that reason, their multiples to sales and earnings are considerably below. Pardon me. That's my daughter's dog that I'm watching right now. Apologize for the interruption. But their multiples to sales and earnings are considerably below the averages for the stock market indexes. Recently, I reviewed 2 PF growth portfolio holdings that have lost ground recently. I also commented on one of our income portfolio holdings that I believe is fundamentally undervalued. Now here's the first article I alluded to, when the whole is worth less than the sum of the parts, and the other one is Enbridge, a dividend aristocrat in the making. In all 3 cases, I believe it is only a matter of time until Wall Street realizes they have become oversold and starts bidding their share prices up to more reasonable valuations. That's this week's PF video update, and I look forward to talking to you another week. Thank you.